Do you want to target higher returns over the same investment period? Do you want to understand the investment choices that 97 years of data show create wealth gaps? The answer is simple. Understand small cap correctly. But never miss the but part. Why does it work? This slide explains it all. From 1926 to 2023, this is long-term data from the Ibbotson SBBI. With dividends reinvested, on a nominal return basis, small cap has outperformed large cap stocks. This is a statistically confirmed trend. But here's what matters. The definition of small cap varies by index. The Russell 2000 classifies by market cap ranking. The S&P 600 requires profitability. Even under the same small cap label, their characteristics differ. And the past decade has shown a different reality. Large cap tech stocks, led by the Magnificent Seven, dominated the market. The 97-year average and the recent experience diverge sharply. Small cap superiority is not a guaranteed formula, it's a conditional trend. Today, I'll show you the complete picture accurately. First, understand the definitions precisely. Get this wrong, and your investment judgment breaks down at the foundation. What is large cap? These are companies worth trillions of dollars, like Apple and Microsoft. NVIDIA reached the trillion-dollar tier at certain points as well. But market cap fluctuates every day. Treat these as estimates at a specific point in time. How is small cap defined? Here's what matters. There is no single definition. The Russell 2000 ranks all U.S.-listed stocks by market cap and takes the middle 2,000, excluding the top 1,000. Because it classifies by ranking, there is no fixed dollar range. And it includes unprofitable companies. The S&P 600 is different. It requires profitability. This filters out low-quality companies. In reality, this difference significantly impacts long-term returns. By number of listed companies in the U.S., small cap makes up the majority. But by market cap, large cap dominates the market. Understanding this structure is the starting point for small cap investing. Let me show you the numbers. But first, let me be clear about the assumptions. These are figures from a long-term data series called the Ibbotson SBBI. Dividends reinvested, nominal returns, before taxes and fees. With that in mind, let's look at the data from 1926 to 2023. Small cap annualized return, approximately 12.1%. Large cap annualized return, approximately 10.3%. The gap is about 1.8%. Let's calculate what that gap produces. You invest $10,000. After 30 years, large cap grows to approximately $167,000. Small cap grows to approximately $283,000. A difference of $116,000. What about after 40 years? Large cap reaches approximately $505,000. Small cap reaches approximately $1.03 million. The seven-figure milestone, a difference of $526,000. But there's an important caveat. Real investing comes with fees, taxes, and transaction costs. These work to narrow the gap. And nominal returns don't account for inflation. There's one more reality you can't afford to overlook. Whether investors over the past decade actually experienced this 97-year average, that's a separate question entirely. This is the heart of the but. Let me be honest and precise. Small cap tends to carry higher volatility than large cap stocks. This is a statistically confirmed trend visible in data such as FAMA French. However, specific figures vary by period and by index. Let's look at one data point from a crisis, the 2008 financial crisis. Comparing calendar year returns. S&P 500 down 37%. Russell 2000 down 33.8%. Take note. This was a rare case where large cap stocks fell harder. The giants of the financial sector were the epicenter. What about the 2020 COVID crash? Here we look at maximum drawdown from peak to trough. Russell 2000, approximately down 41%. S&P 500, approximately down 34%. In this crisis, small cap fell significantly harder. The numbers change depending on which index you use. They change depending on how you define the time period. Understanding these facts before reading the data is critical. Don't ignore liquidity risk either. Individual small-cap stocks have low trading volume, and spreads tend to widen sharply during volatile periods. Investing via ETF mitigates this through diversification, but the liquidity constraints of the underlying assets remain. And the most overlooked risk of all, bankruptcy risk. Indexes maintain their returns by rotating out failed constituents. But when you invest in individual small-cap stocks, the risk of a company disappearing is not zero. This is exactly why buying via an index matters. Why has small-cap outperformed large-cap stocks in long-term data? And why hasn't it in recent years? Let's examine both. The reasons for excess returns aren't singular. Multiple factors are at play. First, information asymmetry. Large-cap stocks are followed by many analysts, and information is priced in almost instantly. Small-cap stocks have less coverage, leaving more room for inefficiency. Second, risk compensation. In their 1993 research, Fama and French modeled the small-cap effect as a risk factor called SMB. The interpretation: small-cap stocks demand higher returns because they carry higher risk. It's not so much a loophole in efficient markets. It's largely compensation for risk. Third, institutional constraints. The larger the fund, the harder it is to allocate meaningfully to small-cap stocks due to liquidity and market impact issues. With less competition, undervaluation tends to persist. But let's face the recent reality head-on. Since 2010, the S&P 500 has consistently outperformed the Russell 2000. The mega-cap tech stocks, known as the Magnificent Seven, drove the market. In the high interest rate environment of 2023 to 2024, small-cap stocks with heavy debt loads struggled especially hard. The 97-year average and the investment experience of the past decade diverge sharply. Small-cap superiority is not a law of guaranteed victory. It's a statistical trend over the very long term. So how should modern investors approach this? This is the core of practical application. The first decision to make when investing in small-cap: which index to use. The Russell 2000 versus the S&P 600. Both are small-cap indexes, but their characters differ. The Russell 2000 includes unprofitable companies. Among its constituents are companies that may not survive. The S&P 600 has a profitability requirement. Only companies generating earnings are included. In long-term data, the S&P 600 tends to deliver better returns. A 2018 AQR study confirmed that the small-cap premium is found in quality small-cap stocks, excluding low-quality junk companies. The modern strategy is simple. If you're buying small-cap, don't just buy small companies. Select high-quality small-cap stocks with proven profitability. If you're investing via index funds, check the index construction rules. Understand the relationship with economic cycles as well. In expansions, investors take on risk. Capital tends to flow towards small-cap, where growth potential is greater. In downturns, large-cap stocks with stable cash flows tend to show stronger defensive characteristics. This is a tendency, not a perfect prediction. But understanding the big picture changes how you make portfolio adjustment decisions. Now let's organize the thinking around allocation. But first, I want to make one thing clear. There is no single correct answer for optimal allocation. It depends on your age, income stability, other assets, and risk tolerance. With that as the foundation, here's one framework to consider. Ages 20 to 35. Large cap 70%, small cap 30%. This is one approach. You have time. You can wait for recovery after a crash. This is the stage where you can maximize the benefits of compounding. Ages 36 to 49. One option is to shift toward large cap 75%, small cap 25%. A balance that protects accumulated assets while still targeting growth. Age 50 and above. A direction of large cap 80%, small cap 20%. 10 to 20 years until retirement. The stage where time to recover from major losses is limited. These are examples only. Research from firms like Vanguard also holds that optimal allocation depends on individual circumstances. What matters is building a plan that fits your own life. 2 practical notes to add. When selecting a small-cap ETF, check whether it tracks the Russell 2000 or the S&P 600. Understand the index construction rules. Rebalance once a year. That's the baseline. Remove emotion. Run it as a system. What allocation fits your age and situation? Think about it again today. Now let's bring together the key points from today. Here's today's summary. First, small cap's edge is a 97-year statistical trend, not a guaranteed law. The Ibbotson SBBI long-term data confirms a tendency for small cap to outperform large cap. But over the past decade, large cap tech stocks dominated the market and small caps struggled. There is a sharp divergence between the 97-year average and the modern investment experience. Second, small cap risk is multi-layered. Higher volatility, liquidity risk, and bankruptcy risk in individual stocks. Depending on the nature of the crisis, it may hold up better than large cap, or it may fall much harder. Diversified investing via index ETFs is the practical tool for managing these risks. Third, which small cap you buy is critically important. The S&P 600, with its profitability requirement, tends to deliver better long-term returns than the Russell 2000, which includes unprofitable companies. As AQR's research shows, the premium exists specifically in high-quality small-cap stocks with proven earnings. Does your portfolio include small-cap? If it does, which index are you using, and what percentage of your allocation? Is that choice truly aligned with your age and risk tolerance? Share your strategy in the comments. Your allocation thinking, your questions, your real experience. All of it becomes the wisdom of this community. Thanks for investing your time with me today. On this channel, we break down not just the small cap versus large cap decision, but concrete strategies for asset allocation, risk management, and the path to financial freedom, backed by numbers and evidence. If you want to build wealth with data instead of emotion, with a blueprint instead of a dream, subscribe and turn on notifications. Let's build your wealth blueprint together with precise knowledge. See you in the next one.